Have you ever paused to think about where money truly originates? While many of us might picture a government mint printing endless streams of cash, the reality is far more intricate and largely happens within the private banking system. This process, known as fractional reserve banking, is the invisible engine that powers much of our modern economy. Today, we're going to pull back the curtain and demystify how banks actually create money out of what seems like thin air. It all begins with a simple action you've performed countless times: making a deposit. Imagine you deposit $1,000 into your bank account. Your account statement shows a balance of $1,000 and you can withdraw it at any time. However, the bank doesn't just store your cash in a vault with your name on it. Instead, banking regulations require them to keep only a fraction of that deposit on hand. This is called the reserve requirement. If the requirement is, for instance, 10%, the bank must hold on to $100 of your deposit. The remaining $900 is now considered excess reserves. And this is where the magic of money creation truly begins. This initial deposit and the subsequent division into required and excess reserves form the foundational principle of the entire system. With that $900 in excess reserves, the bank is now in a position to issue a loan. Let's say another customer, Alex, wants to buy a new bicycle and takes out a $900 loan. The bank doesn't hand Alex a stack of cash from its vault. It simply credits Alex's account with $900. Alex then uses this digital money to buy the bicycle from a local shop. The shop owner, in turn, deposits that $900 payment into their own bank account. At this moment, something remarkable has happened. Your initial $1,000 is still recorded in your account, but an additional $900 now exists in the bike shop's account. The money supply has effectively expanded. This cycle of lending and redepositing is the core mechanism that multiplies money throughout the economy. This multiplication effect can be understood through a concept called the money multiplier. Following our example, the bike shop's bank now has a new $900 deposit. It must also adhere to the 10% reserve requirement, so it keeps $90 and can lend out the remaining $810. That $810 is then loaned out, spent, and redeposited elsewhere, creating another new deposit from which more loans can be made. This cascade continues, with each step creating a smaller amount of new money. Theoretically, your original $1,000 deposit could ultimately support up to $10,000 in the total money supply within this 10% reserve system. The money multiplier illustrates the powerful, exponential potential for money growth that is built into the banking framework. The implications of this process are profound and directly impact our economic lives. By creating money through lending, banks facilitate investment and consumption, which can fuel economic growth. Businesses can get loans to expand operations, and individuals can get mortgages to buy homes, stimulating activity across various sectors. However, this expansion of the money supply also carries significant risks. If money is created too quickly without a corresponding increase in the production of goods and services, it can lead to inflation, where each dollar buys less than it did before. Central banks attempt to manage this delicate balance by adjusting interest rates and reserve requirements, influencing how much banks lend and consequently how quickly the money supply grows. So the next time you look at your bank statement or use your credit card, you'll have a clearer understanding of the complex and dynamic system working behind the scenes. This journey into fractional reserve banking reveals that money is not just a static object, but a dynamic flow, constantly being created and circulated in a cycle that shapes our entire economic world.